to this Social Market Foundation and Investment Association Fringe event. If we haven't met before, I'm James Goh. I'm not any longer the director of the Social Market Foundation. I have to remind myself of that. I left that job in summer. I'm now a mere fellow of the SMF and doing a job as a partner of a company called Colour Advisors by being a keen supporter of centrist policy making in public interest. And the use of private capital for public good, which is really, I suppose, the theme of this event. Before we get to the thing you're actually here to listen to and participate in, actually do some housekeeping. I think the main things I'm going to tell you are that the door behind you is the fire escape. There are no fire plans. If bells and whistles go off, then you should panic and run through that way. The other thing is that when we come to Q&A, that camera over there, hello camera, is currently live streaming this event to the SMF YouTube channel, which means that the audience is not just people in the room, it's also the internet. And when you come to questions, the microphone will pick up your question, so you're not just talking to friendly colleagues in the room, you're also talking to people outside the room, and your question will be recorded online for all time. So just bear that in mind. That's I think all the housekeeping we're going to do. In terms of running on, I'm not going to give you long public biographies of the speakers. I'm going to let them introduce themselves. But just to remind you who everybody is, we're going to hear first from Chris Cummings from the Investment Association. He's going to be followed by Emily Shepherd from the Financial Conduct Authority. The additional mystery guest on my right, who does not have a name tag because she was added happily late in proceedings, is Tracy Blackwell, Chief Executive Officer of Pension Insurance Corporation. And our final speaker for the magisterial stirring up some, bringing to your feet, exciting enthusiasm, is Gareth Davis, the Secretary to the Treasury. So they are all going to be talking about our essay question of the day, which is investing for growth, how to create jobs and support the economy by boosting investment. How do we essentially get more money going into good stuff that does things that we like and makes the country better? So that's the topic, that's the theme. I'm going to hand over to Chris Cummings, who can tell us how investment and investment association members, I expect, can make the world better, happier, and more glorious. Chris.
Thank you, James. Well, nothing like an easy question to begin with, make the world a better place. Good morning and welcome. As James said, my name is Chris Cummings. I'm the Chief Executive of the Investment Association. That means we're the representative body for UK-based fund managers here in the UK. That's an industry that manages some £10 trillion of other people's money. I guess I'm looking at some of them here today. So if you're saving into an ISA, putting some money aside for a pension, wanting to enjoy a more secure standard of living later in life, it's my members who are trying to do their best for you. By investing here in the UK, about 75% of UK households now use the services of an asset manager, somebody who can help you look forward to a better standard of living in retirement. And we do that by deploying that £10 trillion of capital into higher growth companies, into infrastructure projects that need greater support, by buying government debt, and by looking for a long-term return on your investment, with certain characteristics that genuinely do go to helping make the world a better place. So, as you all know, there has been a sustained and substantial growth in sustainability investing, as more institutional and retail clients express strong views around how they want their money to be invested. We manage around £10 trillion, but deploy about 1.6 trillion into the UK economy. That means we own about a third of the FTSE, and I'll be happy to say a little bit more about how else we think more finance can go into creating high growth companies, better jobs, and addressing the issues that investors want to see, not just here in the UK, but because our industry is so global around the world as well. But I do recognise we've got a particular focus on the UK today. Thank you, James.
Chris, thank you very much indeed. I'm just putting you on notice, I can come back to that That question later on about high growth companies and what can be done to promote them, because there's a high need to plug the SMF. The SMF published a very good report on high growth companies and how to support them. I think it was last week, well, the readings of it, so we'll come back to that. I'm now going to hand over to Emily from the FCA to tell us how can regulation support good growth and all these wonderful things which we'd like to see happen in the world.
Thanks, James. So my name is Emily Shepherd. I'm the Chief Operating Officer and Executive Director for Authorisations at the Financial Conduct Authority. So first thing I'm going to say is that the FCA is changing. So we are looking to transform, and that's transform with a capital T, to become more assertive, adaptive and innovative. And in that context, we are sitting on still the second largest global financial hub in the world in the UK. We are unique in the full services. We've got, in 2021, we had £14.7 billion of equity was attracted into the UK for UK and international investment. And I think Chris just mentioned 10 trillion assets under management. 21, it was 11 trillion, but still significant portfolio of assets under management. We remain number one for international debt issuance and for FX. And on fintech, we have 4 times as many fintech firms who choose to locate themselves in the UK versus, say, Germany and France. There was slightly more news today saying that we have now beaten San Francisco, but I'm not sure about that one. So the 3 areas that I think the FCA that I'd like to speak about, if questioned, are around strengthening the wholesale markets. For us, I think this is helping the conditions for investment and sustainable growth generally. So we are going to be adapting the listing rules regime. The draft handbook and CPA is due out later this year. We've also created rules for transparency, which were published in May 23. The second thing a regulator can do is create an environment that supports and encourages innovation. So the FCA were the first regulator globally to create a sandbox. That sandbox is now 24/7. We've gone further though. So the Khalifa Review talked about having a nursery or some sort of environment to help and support new business types, new firms and high growth firms like fintechs in that regulatory journey. So we have created our early high growth oversight function, which has now just celebrated its first year. And the final piece there is on sprints. So we work with the industry and support on creating sprints to solve specific questions, specific problems in the industry, or even on policy. We have policy sprints too. The final thing is standards. So standards is something that sets the UK apart. We've got really strong standards. We are looking at the way that we are now approaching them. So for example, consumer duty. So consumer duty is a very different way of having those standards. This is outcomes-based, so we're putting the control back into the boardroom. There is a member of the board who is responsible for consumer duty, and they have to think through things like value for money. It doesn't mean there's a race to the bottom. Value for money in investment terms means you are paying for what you get. The return has to be good if you have high charges. So the last piece of standards, I'd be remiss if I didn't talk about authorisations. Now, authorisations is one of those areas that it was in trouble 2 years ago. The queues in authorisations were incredibly long. And that's where we have really listened to industry, we've listened to what you want, what you need, and we've invested, and we're now down 60% on that queue time, or the queue in total over the last 2 years. So, for example, changing control, we now act on those within 48 hours. Senior management regime, senior management function, it was taking about 6 months for somebody to get approved, authorised. It can take 3 weeks if someone comes who is ready, willing, and organised. So we've made massive improvements already on authorisations, and we're now digitising it. So we went live last week with our first form there, with many more to come.
Thank you very much indeed. I have a feeling that my feeling is I know we'll come around to talking about consumer duty and value for money, because I'm going to ask you about it, but I suspect that people in the audience might be to get into that as well. Our next speaker is a practitioner also practitioner in the investment world, Tracy Blackwell, CEO of Insurance Corporation.
Hi, and thank you. Sorry, I hope this, I've been drafting in at the last minute, so hopefully this all comes out in the right way. I'm not quite sure. So Pension Insurance Corporation is one of the leaders in the bulk annuity buyout space, and everybody goes, what is that? And basically what we're doing is consolidating final salary defined benefit pension schemes, and have done so in consolidating about 250 over the last 15 years, and we manage between 40 and 50 billion pounds of assets. And as a result, when those DB schemes come over to us, we're big investors in the real economy. So we invest in things like social housing, university accommodation, wind farms, solar, private sector build to rent, and all of those things that are the other bit of productive investment. I think a lot of the conversation that's been going on recently has been about productive investment just being about fintech or growth capital or life science, but actually building the infrastructure of the country is incredibly important. And we look at that as kind of a form of intergenerational transfer. We're using people's pensions today to build the infrastructure of the future, and that's incredibly important. What I kind of would say about, Chris mentioned 5 trillion of savings that's managed by UK asset managers. About 5 trillion of that is the UK savings. And the question I think that everyone's asking is, why aren't those savings being used to support the real economy, and what can we do to get more of that savings directed into supporting the UK? And I think there's two different questions in that, and sometimes they get conflated. So one is just about the structure of some of these industries. So in that 5 trillion, there's different industries. There's defined benefit pension schemes, there's defined contribution schemes, there's local authority schemes, there's personal savings through things like SIPs, ISAs, etc. And all have different barriers and reasons why more of it isn't invested in the UK. And we need to look at each one of those separately and individually to think about what we can do to make it more attractive and easier and have less barriers to invest in the UK. The session I was at earlier, somebody said it's easier to invest as a retail investor in crypto in the UK than it is to buy a mutual fund or a UCITS or whatever it is, and that's not the right thing to do, or to buy a share. Plus, there's tax on buying those shares, which probably isn't very helpful either, where it's not on crypto. So that's problem number one. Problem number two, though, is how do we make the UK a more attractive place to invest in? And that's regulatory, it's corporate governance, it's about tax policy, there's a whole bunch of other things. And we shouldn't conflate those two things. We should think about each of those separately and free up investments where we can all invest our pensions in the UK, but also look at what makes the UK an attractive or not attractive place to invest in.
Thank you very much, Jason. That's clearing the stage perfectly for you for Gareth. I said I wasn't going to give everyone biography, but I will point out Gareth is also a former practitioner in this space who used to manage and invest money sustainably. So it's tempted to say a very example position and actually knows the area he's talking about. Because all of our speakers are experts. But Gareth, so how does it all mesh with government policy and your agenda for growth?
Okay, James, well, thank you for that introduction. I think very kind to have me here today. As you say, I come to politics from quite a long and happy career in financial services investments, so this is a subject close to my heart. But as Exchequer Secretary, I have responsibility for economic growth and productivity within the Treasury, and within that, infrastructure and energy policy. And so the first thing to say about mobilising private capital and creating an environment for business investment is that we're starting from a very strong base. We are the second in the world, when it comes to attracting foreign direct investment stock. The only country that does it better than us is the United States, and I don't think that's a point that's often appreciated. We have some of the world's leading academic institutions. We've got a world-leading, long-standing legal framework that's adopted in many countries around the world. Our regulators are some of the strongest and robust that the world has ever seen. We have the advantage of a time zone that is attractive to investors from overseas, and we have the English language. So unlike a lot of countries around the world, actually we're starting from a really strong base. But clearly the first thing that we need to do in terms of making sure that the business investment environment is strong, is ensure that we have a strong and robust, sustainable economy. And that's why the priority of this government at the moment is to get inflation down, to really bear down on inflation is the number one priority of the Prime Minister. It's in a downward trajectory, but there's longer to go on that. And of course, as part of that, once we tackle inflation, we can start to grow our economy even more than it is already. We know that we were one of the fastest to grow out of the pandemic, and we've grown faster than Germany, Italy and France, but obviously we want to go far further on that. In terms of what we can specifically do beyond management, basic management of the economy and getting inflation down and growth up, we need to ensure that we have a competitive fiscal environment. That's why we've got the lowest corporation tax in the G7. That's why we've got the most generous system of capital allowances in the OECD. It's why we've vastly expanded our R&D tax credits to be one of the most competitive in the world. So the effective rate of taxation when it comes to business investment is genuinely one of the leaders in the world and one of the most attractive. But as businesses will tell us frequently, it isn't just about taxes. It's about access to a skilled workforce, and I've mentioned our academic institutions, but the reskilling of our workforce is also a vital component to this. It's also important to create the mechanisms across the world through trade links to ensure that we have a free flowing of trade, and that's why things like CPTPP with the fastest growing nations in the world, why bilateral trade-specific agreements like those that we have with Singapore, for example, are really genuinely going to make a significant difference. And finally, it's about putting in place the market mechanisms to ensure that we can mobilize more private capital. On energy, we have the contract for difference system, which has essentially transformed our offshore wind to make us the world's leader in offshore wind capabilities. We've got the UK Infrastructure Bank, which has a target of mobilising up to £40 billion of private capital investment into our infrastructure. We've got the British Business Bank, who have patient capital, who have a goal and are doing really well at mobilising private capital investment for the fastest growing companies in the country. And as already been mentioned, the Mansion House Compact, which will essentially tap the trillions of pounds that are held in pension funds but have been historically underinvested in fast-growing companies and real assets. That will make a transformative impact, I think, in terms of making sure there's more capital going into the things that we want, and to make sure that the investment environment is one that is not just returns focused, but it is achieving something which we haven't historically done before, which is to take on more risk in a pragmatic and reasonable way to ensure that pensions have a better return, but also that the investment projects that need financing have access to more additional capital. So I'll leave it there, James.
Thanks, questions very much, Jared. I'm sure the winners will, if they don't mind, will come back to that question of Mansion House returns. But before I do that, I've used my program as chair for allowing all of you to ask your much better questions than I'm asking back on my own. To all of the panel, actually, and it's about consumers, or about individuals or individual owners. Because Chris started talking about other people's money, and he's right on to it's not other people's money, it's our money. Somebody owns this money somewhere. And there's a theme across all of your comments in different ways about how and whether or how we can, if we should, make changes in policy and practice to engage the owners of that money more in the choice, the allocation of their money. So Tracy said it's currently too hard for people to have full choice about where the money goes. And it talks about regulating consumer duty. Gareth works for politicians, he works for the voters. He wants to give them he wants to give them choice and freedom. I'm going to go. I'm going to write you some Chris. How do we make sure that people who own the money, people members are controlling, that they have more control, more engagement, more say over where it goes? What's the answer to that one?
So to me, this is the profound question, and we just got to get this right. because we live in an age of reckless prudence, where actually what we've been through for years now is that sense of disempowerment, where people just don't think about their savings, get worried about not saving their pension. Is something that somebody else worries about. We had a really significant public policy intervention called auto-enrollment, which was that robust thing, government initiative that actually worked and made a big difference to our nation. Far more people now save for a pension than ever before, but not at a high enough rate. And my worry is that actually in 20 years' time, many people will look back and think, hang on, government told me it had sorted out my pension, but I'm looking at pensioner poverty. All I can see is a retirement where I'll have to retire later and work hard. So we've had reckless prudence from a policy making point of view. We've also been through a period where actually the narrative has been around investor protection, consumer protection, and people have been protected against engaging with their own money. Now, we're all consumers, we all spend money, we make a decision every single day. Do you, when you want to buy a cup of coffee, which coffee shop do you go in? Is that driven because of your values or the cost of the coffee? But we don't apply the same thing when it comes to thinking about our retirement and directing where you want that money to go. So you can decide to walk into shop A, but actually as an investor, as a saver, as an investor, you could own some of shop A. Or if shop A isn't to your liking, you could say, I don't want to invest in shop A, I want my pension investment to go to retail outlet B. And so we need to start engaging all of us as savers and investors. So I want to see the language of regulation move on from consumer protection to consumer engagement. That's the only way we're going to fix this, because it will be a matter of no consequence if we tell people they have options to do one thing or another, if they're not the slightest bit engaged with it. So we need to start more at an earlier age of helping people understand that the government won't provide for you a good standard of living in retirement. Your current employer has other things that they can be doing for you rather than thinking about providing for you in retirement. The risk is with you as an individual more than ever before, and that is not going to change. So we need to get people engaged in this subject, not protected from it, but engaged with it. So that is the profound difference. And we need to move the conversation on from the only thing we look at is cost, because cost is easy to see, but to value, that's the return generated after costs, because this is your money. So asking bigger questions about value delivered rather than cost on the way in is hugely important. And then we can start talking to people about products and solutions. But really, if you've got a shop that nobody even wants to walk in, it really doesn't matter how you rearrange the products on the shelf.
James, can I just talk about the engagement thing
Please,
for a second?
please.
Not a positive, from a positive perspective, because we are sitting at the biggest shift in how long-term savings are managed in this country in a generation. It is profound. It's not hyperbole. That is what's happening. So DB schemes are closed. It's not going to happen again. They're moving into the insurance world. We're going to invest in infrastructure. Great. DC, as Chris said, is the future. We'll need to save more into that. Contribution levels must go up for people to have secure retirements, et cetera, et cetera. So all of that makes perfect sense. How do we engage people to engage with their pensions and to really look at what they're doing and take responsibility for it? So I sit on the board of the ABI, Association of British Insurers, and last year we ran a campaign called Pension Attention. Actually, we've just done the second round now, where we had a rapper called Big Zoo. I never heard of him. You guys may have. I didn't. Who won the BAFTA last year, and he did a rap called Pension Attention, and it was absolutely brilliant. If you haven't seen it, you need to go out there and look. And 20% of the population saw it. Not people like us, probably, but through TikTok, etc.
Are there any Big Z fans?
Are there any Big Zoo fans in here? No.
You know what Big Z's
I know, I know.
needs?
But of those, 20% of the population, obviously of the younger generation, saw it. 90% went and engaged with their pension and did something. That is amazing. And I think perhaps we just need to have a slightly, dare I say it, the younger generation has a different way to engage than our generation does. And we need to think about the world that way in order to get them to engage. But I'm really, really positive because I've seen the outcome of it.
And in the UK, we had the Tell Sid campaign at the launch of the privatisation drive, and everybody in the country understood what Tell Sid.
Exactly right.
To tip Gareth off, he's getting questions about popular capitalism and conservatism at the end of this, but before we get there, I'm going to come to Andy because, I mean, you've heard, well, particularly, I'm curious to know your thoughts on Chris's point particularly there. You've heard the argument that in your well-meaning desire to do your job, you're protecting people from choice. You're protecting people out of engagement. Is that fair?
It's not quite how I would translate what Chris said, but
You surprised me.
so I've only been a regulator for 2.5 years, and before then I was also in industry, as Chris knows, because I used to sit down tables with him. So Chris talked about disempowerment, and that leading to things like the auto enrolment legislation that had to come to force people to effectively enroll by default into pensions unless they voted out. So for me, the conversation is around financial inclusion and that education piece. Now, it doesn't actually belong to the FCA, this belongs to MAPS as a responsibility, as a remit. But we are there to help support our fellow regulators in getting the messages out. So financial inclusion, the failure, if you like, of financial inclusion means that part of the consumer duty is to simplify the language, to make sure that people understand what it is they're buying in very plain English, to stop some of the barriers, some of those sludge practices. And as I said right at the beginning, it's about value for money. It's not a race to the bottom, it's value for money. And the control of the translation of consumer duty belongs to the board. It belongs to the firm, for the firm to see what is right for their customers, their clients, and to set their standards. This is an outcomes-based regulation. It's a very different way of doing it. So it doesn't automatically fail-safe everything. It's not so much about putting a big safety net and never letting any consumer fail in an investment. It's important that investments do go up as well as down. But that's where we're getting in.
Thank you very much. We may, if there's time, I may ask you if I need some guidance later on. Favorite copy of mine, but I'm not going to go up now. I'm going to, and Gareth, what you from a voter perspective, and remember we are SMS cross-party think tank, but we're in a Conservative Party conference. Any thoughts from a Conservative perspective on this? Is there, should the Conservative Party be aiming for a popular capitalism where we are all a little bit more American, a little bit Australian in our attitudes, where we think, this is my money, I'm going to manage it, I'm going to take responsibility? There was a lady who led this party once one time, I had thoughts on that stuff. I forget her name. What's the Conservative view of the consumers in investment?
I can tell you my view. I think it was 1929, Neil Skelton wrote a piece about property owning democracy. And over the decades, that translated into different things for different prime ministers. For Margaret Thatcher, who you allude to, that was about owning your own home. But I think an underappreciated aspect of having a stake in the economy and essentially owning a part of our future prosperity that has been underplayed is to do with our savings and participation in the markets and investment products. And Chris mentioned auto enrolment. We have completely underplayed the success of that. 10 million people are now saving for a pension that didn't save before. The other aspect that's underplayed is the fact that it was genuine cross-party consensus and achievement, where there wasn't the usual ding-dong across the House of Commons chamber. We all agree that this is a good thing. That's why we've recently extended it to 18 to 22-year-olds, which is something as a backbencher on these panels I consistently hoped we would do, and now we are doing, because one thing that will achieve is instilling in a very early age this mindset about saving for a retirement, even if it may be decades away. The compounding effect of saving for a retirement will be potentially transformative and make you more independent of not just of the state, but financially independent in later life and more secure. But we do have to do other things to change the culture of saving, the culture of risk taking. I think the fact that we've now got over £70 billion in ISA products is really important, and they've been a real success story too, and we could go further with that. But there are other aspects, like, for example, when you apply for a job or there's a job adverts is a great example where typically it'll mention the salary, but it won't mention the pension on offer, and that can be almost a third of the total compensation that you will get. So it's things like that that I think, employers have a role to play, and we all have a role to play in ensuring that we foster this culture. The overarching theme, though, and thing that we can do the most of is to ensure that there's transparency, so that people can see where their money's invested, see what is available to them in the first place. And simplicity, I think, is the other aspect, where some people just feel like they just can't access these products, or they don't know how to. And so if we can find a way in which we are more transparent and offer simplicity in the product offering in particular, I think we can make a lot of progress to what we want to achieve, which is ultimately to have more people having a stake in our economy. And that way, as Conservatives, I would argue that if they've got a greater stake in the economy, they'll pay greater attention to economic policies, and they won't be voting for a party that will rack up debt, fuel more inflation, and run the economy in an unsustainable way.
Now, before I go to the audience's question, there are a couple of journalists in the room who want to pin you down on one particular aspect you just talked about, which was that point on job ads and pension information on job ads. Just to go, your view is that employers should be including pension provisions on the face of the job that should become. It would be good if that was the norm, to advertise salary plus pension contribution at the same time.
I was making an observation that it's interesting that doesn't happen, and if it is possible to include that information, then that would be an interesting thing for a potential employee to know what the total compensation package is. If we're talking today about how we get more people focused on saving for retirement, knowing what you're going into in terms of the pension offer would seem to me like a pretty straightforward thing to be aware of. Obviously, they can ask about it in interviews, but it's just an interesting observation that a lot of ads don't include that.
You won't say I will. The employers should put pension details in job ads. Well, now it's start taking some questions. So if you have a question, put more on the air. I will just say, as I am a recovering journalist, I have a strong aversion to people making speeches on these things. So if you're going to make a speech, at least pretend, raising the anything else at the end, pretend it's a question. So I'm going to start front row over there. Do we have a roving mic? I don't know. No, just shout. It's fine. If anyone can't hear, let me know if you can't hear the questions. I'll repeat them.
Hi, it's Anne from Hargreaves Lansdowne. I just wanted to pick up on a couple of the comments. I noticed Emily mentioned investments can go up and down, and Gareth talked about the power of long-term compounding. There's a sort of question there to me around what is the messaging we're putting in disclosures at the point where we're trying to encourage people to invest for the first time. If we're saying you're going to lose all your money tomorrow, we shouldn't be investing your money tomorrow.
So
are you with your outcomes-based approach, are you going to be looking at that disclosure regime to think about how we behave and drive the right outcomes?
So that's a narrow question to get to on the language, and probably a wider question to everybody else, maybe on how to strike the tone to the wider public. Is that reasonable?
Yeah.
So maybe bring your first up before you go wider.
No, so it's an interesting notion. I mean, the consumer duty is new. It only came in at the end of July. It only applies to new products at the moment. Come next July, it will apply across the board. So I don't think there are any views at the moment in changing that specific disclosure. But I'm always interested, or we are always interested in ideas. If you think that is the thing that is stopping people investing. I think that there's a sort of reality as well of, the context of the economic environment at the moment. We are still in a cost of living situation, I'm trying to call it crisis, but a situation there, and people do not necessarily have that spare money to invest at the moment.
Chris, are we too deep on that? Is the regulatory messaging too doom-laden? Is that putting people off investing?
So I think as a nation, we need a conversation about risk, because we've been locked in a discussion where we prioritise safetyism more than anything else. And it comes back to the point I make about protecting people from themselves. There are people who have money to save. There are people who have money to invest. And I applaud the speeches by the FCA where they've highlighted people who've sat on cash rather than taking more sensible investment strategies. You know, it's possible today to get into debt almost friction-free, taking out credit cards. It's easy today to buy crypto. Much harder than investing in your ISA. So it's not a level playing field, and the answer to that isn't to level up, by the way, and introduce further regulation. It's for us to have a more grown-up discussion and to understand that protecting people from taking risk is a huge risk. No risk is actually risk itself. And I think we've just got the equation wrong, and I think we do need to have a more grown-up discussion with people because nobody else is going to do it for them. And that's been a big game changer with the closure of the vast majority of DB schemes into DC and just the number of typical jobs that people will have these days. So my own view, is that a review of disclosure, which moves us away from an analog paper-based system full of all the risks to a just-in-time behavioural psychology-informed nudge-based system, making use of technology, will just encourage people to look after themselves better. And then we'll need to worry less about risk and protection and a lot more about how regulation can encourage engagement, which is what I'm sure we all want to see.
So you're nodding in the affirmative to that.
No, I think the whole risk-based culture, which goes through the entire economy, not just in terms of investments, is incredibly important. And I think it's a very, very good point you make about the disclosure, because all of it, you listen to an ad on TV and it's all doom laden, investments can go down as well as up, which is all great, but how about if you're not saving enough for your retirement, you're not going to have an appropriate retirement, is also incredibly important. Exactly.
Gareth, you mentioned Mansion House earlier on. Is Mansion House and that push towards more risk-taking and a focus on returns, is that intention with protecting people from risk? How do you reconcile those two things?
I think it's based on appreciation that as a country, our pensioners have typically been underinvested on an overall asset allocation basis to faster growing companies, lower down the spectrum in terms of the size of those companies. I think more broadly, I would observe that there's been an underinvestment in real assets, in infrastructure, private equity, and venture capital, while we've created some mechanisms to help investors access, for example, venture capital. I think you could go further. And so the overall observation is that we need to do more to ensure that pensioners have access to higher returning assets. And yes, that does mean, where appropriate, there is additional risk. But as Chris has pointed out, sometimes not taking more risk is riskier than not doing it itself. And so just sitting on cash for decades is obviously not going to help you when it comes to retirement. And obviously, each individual will have to take their own advice, and far be it for me to offer investment advice. And investments do go up as well as down over the long period. But the overall objective that we're seeking to achieve is to ensure that pensioners have a more secure and prosperous retirement, while we're also able to unlock assets that have been under-allocated to the things that we want to boost investment in.
Next question. I'm going to go to Gemma Coleman, second broker. That's all right.
So Gemma Coleman from the Institute of Government. There's only been a very brief mention of tax in this whole event so far. I was wondering what your views are on, there's quite a lot of features of the tax system that try and incentivise one form of investment or another. Do you think that's working well? I suppose to make the question a little bit harder, if you couldn't do a net tax cut, would you refocus the current tax incentives differently to achieve more of the kind of investment growth?
Pro-investment tax policy in 30 seconds. Easy subject. Who wants to go first on that?
I can kind of go first. And this is actually slightly a question as well as there's about £800 billion sitting in SIPs, individual investment accounts, et cetera, et cetera, et cetera. So for anybody to invest, and a lot of people probably in this room have those sorts of things, for people like us to invest in those high growth companies, high growth things, venture, private equity, it's almost impossible. And one of the things that makes it almost impossible is all of the tax. No, it's not the tax system, it's the disclosures and all of the rigmarole around it. And I think the stuff to make sure that people aren't skipping tax, so to speak, and not trying to find a way around the tax system actually acts as a brake. It's another layer of stuff that you just have to do where people eventually just give up. And so it's not just the level of tax, I think, that we need to look at. It's all the stuff that goes around you having to declare tax and what you're doing, and that makes it more difficult.
I would look at, again, the ISA regime. I think it's become overly complex. I think there should be greater incentives for what you used to call stocks and shares ISAs than their cash equivalent, a return to the TESA regime, because that actually encourages people to start saving a little in cash, and then as they get exposed to risk, then they can move into more of a risk-based environment. So there's a ladder there. I think it's tremendous. Just a bit of a plug. We've done some work looking at the cost to the UK of not having a VAT zero fund regime. Our major competitors have a VAT zero regime, Luxembourg, Dublin. Quite straightforwardly, for every £1 billion domiciled, it throws off about £1 million in tax take. Seems like a no-brainer, but the problem is, if you're looking actually at the future benefits of future tax take, as against any marginal reduction in tax take immediately, and I think we get lost in that sometimes as a country. What's the net present value of future tax take that we need to bear in mind? So those are a couple of recommendations from me.
Darren, we are conscious the open statement is approaching, and this may just condition what you say, but within those confines.
Yeah, I would just point out, as I did right at the beginning, if I take it in two parts, business investment and personal investment. So from a business investment standpoint, first thing to say is it's not always all about tax, as I laid out. There's lots of other different factors that determine whether a business will invest or reinvest its profits. But when it does want to reinvest its profits and can, we have an incredibly generous capital allowances scheme in the UK, which is the most generous in the OECD. So it is very competitive. If you want to reinvest those profits, you can reduce your overall corporation tax burden. But also, we've expanded the R&D tax credits as well, which ensures that firms, again, that want to invest in R&D can do so in a tax-efficient manner. For individuals, as I pointed out, it is right to highlight the success of ISA products. We're always looking at the efficiency of those products, and providers obviously look at them every day. But that is a very proven, very successful way of saving day-to-day, whether cash or in stocks and shares or whatever it is, in a tax-efficient way. And for the higher-growing companies, those lower down the capital spectrum, VCTs and EIS, that's a pretty robust scheme as well. So I would argue that there's already the mechanisms and incentives in place to boost investment, and we'll make that continue.
Right, let's go two questions on this side together, and then you go to us, and people else are going to become discriminating against them. So, Nigel, are you spotting the question? I probably do. Yeah. Okay. Well, another people, and then the gentleman in the. I'd say is that green or blue? Blue. I thought. Okay. Yes.
Nigel People, the PLSA Workplace Pensions Body. Partly building on the last couple of questions actually about regulation and tax. And I'm interested in the panel's thoughts on what regulatory and tax changes could be done to encourage and draw greater pensions and other savings investment into the UK. And we sort of covered them in my view. Maybe some kind of fiscal incentive for funds to invest in UK companies, pension funds to do so. And secondly, we've already talked about it, the contributions lever. It's terrific the government has actually stepped forward on broadening out a bit, first pound savings and 18, but there's more to do. So I just wonder if these things or others are things the panel can comment on.
Good on that.
Let me start by saying that over the last 3 years, the FCA has done a much better job of engaging, so that's appreciated. At the same time, I think we have a fundamental problem, and that's that we're shifting from historically regulators that protected people from themselves. Now we're trying to shift to educating them so that they can do a better job. That's a hard shift. But one of the problems that I see, carrying on from what Chris said, is that we also have a problem with proxy votes. Proxy votes are not being voted as the investor would invest. They're being voted as the money manager would invest. And that also is a problem, and that's going to require engagement. I would think.
Question arising from that is?
How do we fix that problem? And is it being looked at to be fixed?
So that's, that was a possible question about your better pension investment and engagement, and then the proxy. Should we start with proxies? We start with that first. You're nodding it. There's technology on the way that will help democratize shareholder voting.
There is, and this is, speaking as the investment industry, something that we know we need to be a lot closer to the asset owners on, actually. So in terms of setting the mandate, we need to be really clear, is this an asset owner that is relying on the discretion of their asset manager to vote the shares? How do we sort out the problem of proxy voters with proxy where it's just a box ticking exercise, and that really doesn't help anybody. And certainly there is a misalignment that's crept in, which is between the asset owner, the asset manager, the proxy service that's being used, all of which is making what should be stewardship should be a conducive process to help changing business. It's becoming really aggressive and actually deeply unhelpful. So at an institutional level, I know there are new systems being introduced, and even at a retail level, what we're interested in is much more of an open discussion. But yeah, we can't stay where we have been because it's not a good outcome for anybody.
Is there a regulatory view of that proxy question?
Well, as Chris said, so whether you're looking at the direct asset owner or the underlying asset owner, legally we tend to look at that direct asset owner. So it is around often the fund manager who has the vote because it's a discretionary fund. So it's not something that we are extremely focused on at the moment. I think it would probably potentially fall under consumer duty again if this came up. So it is about how a firm sets its behaviour to its consumers, and maybe it's a differentiator in the future, a differentiator for a firm to say that they are going to represent you, not just the fund manager, in those proxy votes.
Gary, I mean, if your thoughts on proxy question, but also if you can then take us on the seamless segue onto Nigel's questions about more levers you can pull to increase pension savers in engagement and investment risks.
Yeah, I think as it's not in my portfolio, I'm willing to stray a little bit. I'm not.
Laura very nice. She won't mind if you get the pension.
Yeah, I think I'll leave that to our great regulator on the panel to opine on. But VLSA, great question in terms of how you can guide or encourage more investment into our domestic market. You'll know that over many decades, the allocation to our domestic market from our domestic pensions has been in decline, and that really is a long-standing trend. I think there's a couple of things there. One, we're not going to make anybody do anything. That's not appropriate. Pension funds have fiduciary responsibility to ensure the best possible financial return, and it's a global market, so we appreciate that. I think what we can do is ensure there's enough projects for them to be able to invest in, and enough viable investment projects and companies that are accessible to pension funds. So I would just point you to some of the work that the British Business Bank are doing fantastic work through British Patient Capital in particular for accessing investments into higher growing companies, but also we've got the, I think now 2-year-old UK infrastructure bank run by John Flynn, who is really trying to use seed government capital to mobilise, as I said at the beginning, more private capital by having a pipeline of projects that government and private capital can help fund. And I think those kind of mechanisms are quite interesting for being able to shift more pension fund assets into domestic investments. But as a Treasury, we're always looking for ideas and ways in which we can help facilitate an environment in which more domestic investment can go into domestic assets.
Do you want to write our thoughts on the pensions point before I go on to the side of the room?
Yeah, if I could just about UK domestic investment. So as I said in my opening remarks, a lot of this stuff is being conflated. There is, UK DB pension schemes are not going to invest in UK equities. They're closed to new members. That game is passed. But even in open schemes, and there are a few open schemes, not that many, about the 700,000 odd members of open schemes, about 450,000 of them are in two schemes, which is USS and RELPEN. If you look at those schemes, which are open and therefore investing in growth assets, they don't invest in the UK. They invest in MSCI World Index or overseas private equity funds and venture capital funds. So it comes back to the first bit I talked about, which is there's a structure issue and that structure is changing, but there's a how do we make the UK an attractive place to invest? And clearly, even the investors who have all the incentives in the world to invest in the UK aren't investing in the UK, and we have to ask ourselves why that is.
Yeah, just very briefly on this, the government is doing some of the right things here. The MiFID research requirement being unwound. There is a reason why high growth companies go to the US. It's because they meet research analysts who actually understand the intricacies of their business. The way that we introduced the MiFID research rules in the UK, as broadcast at the time, completely decimated the UK-based research industry. So we lack the ecosystem of detailed research analysts to have the discussions with those high growth companies. I am sincerely hopeful that we're going to see a rebirth of the research industry in a different format, fit for the 21st century here in the UK. But it's about getting the underpinnings right so that we can create that richer IPO, high growth environment, which will then create a magnet to attract exactly the type of investment that we all want to see.
5 minutes left. I'm trying to get at least one question, 2 questions right. Both on the aisle, like lady there and then the gentleman behind you. If you do your 2 questions in one bundle, everyone will give you crisp, incisive answers on beyond our next day. So.
Okay, just quick. I'm Sam from the Finance Innovation Lab. We're coordinating the Fair Banking Reform campaign. So I just wanted to bring us back to Tracy's point very much on the economy earlier on, patient capital, financial inclusion, short-term savings, and very much trying to get people engaged with their money. So there are a group of financial institutions that are very close to their customers and communities. Brilliant work in supporting their members and customers to save and by lending, particularly within multi-product areas, a huge impact in terms of creating new businesses and jobs. We're thinking of credit unions and community development finance institutions.
And the question about credit unions is?
Well, they themselves face huge barriers to scaling their operations and having the impact that they know they could have. So is it time for a Fair Banking Act, the equivalent of a Community Investment Act in the States, that would require mainstream banks, community finance providers, and the regulator to work together so that communities can get the investment they need to apply.
Lovely, thank you. And the gentleman behind you.
Yeah, thank you. Just from the description here, it says of the event, it says generating GDP and growth and creating jobs. My question to Mr. Davis is, I work for a small organization connecting London with the airport and scrapping the tax-free shopping. I work with too many brands in London. They all suffering in this summer because there's no customers. Everyone goes to Paris, why? And that's actually pushing investors away from London. Is the tax-free shopping something you need to look at it? To bring more investors to London?
And you're right with the jobs, the jobs inside of the event, you're pointing out how you share very badly in sort of the jobs, so I apologise. I think those are actually very, I had those 3 questions for Gareth, I'm afraid. Oh, I'm afraid I'm delighted with questions for Gareth. Fair Banking Act, yes or no, and battery shopping. What do you think to that?
Okay, so I think we're very fortunate that we've got a very diverse financial services sector. And a big part of it is the role that mutuals play and building societies and, banks that are based in communities and doing amazing work. They've been one of the key drivers for the take-up of ISAs. I spoke at an event in the House of Commons just recently making that very point. Whether we need, I'm not familiar with the proposed legislation, but I would argue that I think we've already got a pretty diverse system that is proven and successful. And I would argue that actually some of the big banks, the very big global banks, have amazing community operations and are making a real difference to local businesses and individuals in those communities. So that's what I would say about that. Look, on the tax-free shopping, another area that's not in my portfolio, I would add. But
You're wrong friend, we won't tell.
But I do know
Just we really think.
that the analysis that was done at the time that was introduced showed that it would have a minimal impact on visitors to London. We always keep taxes under review, and we'd be happy to see any specific evidence that it is precluding business investment or tourists to the UK. Very happy to receive that. All taxes are under review as always. Sorry?
Speak to London High Street shops.
Look, provide us with the evidence, we will always keep taxes under review. Thank you.
And with that, the clock has now ticked over to 12 o'clock, which means that I am going to bring the event to a close by saying thank you, everybody. I would say thank you to all of you for coming, and I would say thank you to the panel, especially the Investment Association for making this so possible, and especially, I'll ask for a hand of applause for the Minister for Gareth. You know very well how busy concerns are. Our conference was very grateful, Gareth, today, giving us time and thoughts. So, thank you.